Nikhil Nigania, the director at Bernstein, joins in on the show right now. Nikhil, hi, morning. You've been tracking the PFC REC story for quite some time, right? And on this platform itself, we've been speaking about it time and again. But help us understand now with this indexation clause in the budget, what does it really spell for realty holdings for PFC REC?
Yeah, so PFC REC, just to clarify, the way they benefit from capital gains taxation is so there are four entities, four central government entities, which is National Highway Authority of India, PFC REC, and IRFC, who are allowed to issue these special bonds. They are called 54 EC bonds. So what can happen is if an individual makes capital gains tax, capital gains on a real estate asset sale, so they are allowed to invest those capital gains into these special bonds, 54 EC bonds issued by PFC REC, to avoid paying that capital gains tax. So that's how an individual can, sort of minimize this taxation outflow. And the reason PFC REC gains through this is because these bonds carry lower rates of interest. So these 54 EC bonds right now carry a coupon rate of 5.25%, as against an average borrowing cost of PFC of REC of about 7.5%. So if capital gains tax increases for real estate asset sale, then you could see a higher demand for these bonds. So that's how PFC REC gains from this change in clause.
But there was a time when PFC REC would give you a 1%, at least 1.5% kind of a spread over government bonds. That was the attractiveness. That attractiveness is over, right? I mean, now the arbitrage is just not there.
Fair point. Yeah, I think if you look at the bonds, so to your point, you're right. I think this rate of 5.25%, which they are giving on these capital gains tax bonds, 54 EC bonds, I think will have to go up to make them attractive again. Despite the TAM increasing, these rates might have to go up slightly to make them attractive to investors again.
Okay. So, Nikhil, given the current state of things, help us understand what, according to you, are the tailwinds working in favor of PFC REC and the investors who are looking at these names?
For sure. So as you know, we've been bullish on the power sector for quite some time, right? Our broader coverage is also very power focused. So there are four reasons we like these names, or we have liked these names for some time now. Number one is loan book growth potential. So there is intense capex happening in the power sector in India due to both energy transition and a tight demand supply market, and strong power demand as well. It's grown at 8% CAGR over the last 3 years. So all of that would need capex, and capex would translate to loan book growth for these two lenders. The second reason we like them is lower risk of NPAs in future loans given by them to private sector. So for example, loans to private renewables, which should be a good part of their incremental loan book, has lower risk of an NPA as compared to thermal plants, private thermal, which was the last power cycle in India. The third reason we have been optimistic on them is due to the fact that if you look at for a renewable power company, there are 2-3 options to source debt. One of them is PFC REC. The second one is to look at dollar bond market. So what has happened over the last couple of years is borrowing in dollars has become more expensive than borrowing in rupees. And hence, the competitive intensity for these lenders has also come down. So they are able to compete better against dollar bonds. And hence, you'll see that's suppose the loan book growth angle as well. The fourth reason we like these names is, so if you look at the power cycle in India, so we had power shortages before 2014. Then we went into power surplus after till 2022. And then again, we are entered into power shortage phase, or a tight power demand supply phase, especially in the evening time of the day. Because of that, power prices are high. And all the distressed thermal plants in India are now getting sold in NCLT resolutions. So for these lenders are seeing reversal of provisions already made by them for those distressed assets. So so these are the four reasons we like them: loan book growth, low risk of NPAs, lower competition from dollar bonds, and lastly, reversal of provisions from past distressed assets.
Let me throw in one more ingredient in the melting pot, and we're talking bonds here. We're not talking about equity returns in PFC, PFC and REC. The bond setup is looking strong. Inflation is under control. JP Morgan index inclusion, fiscal deficit is coming under check, growth is okay, globally inflation is coming under control. So in a scenario which is in general good for the bond market for next foreseeable future. How do you see bonds of power finance companies moving? Will they have an advantage or will they move in sync with other bonds?
So they should move in sync with other bonds. So in fact, if the bond market becomes very active, especially if, let's say, for example, if dollar rates of interest fall faster, dollar interest rates fall faster than rupee rates, then we could again see renewable companies looking to borrow directly in dollars than borrowing from PFC REC. So yeah, that's how they should move, I would say. So
What about the
if
equity?
US rates are cut, negative for them in a way.
What about the equity valuation? Now I'm just going to change gears, bond to equity. I mean, ultimately these stocks are also valued on their book value and yields, right? What happens to the underlying equity valuation of PFC REC in this kind of a macro setup, which you just spoke to?
Yeah, so a rate cut is slightly negative for them, right? Because their source of funds, a lot of that is long duration, where the rates don't come down. So the equity valuations, if you look at them, these stocks have obviously rallied very well over the last couple of years. But still, if you look at our target price, which is about 15-20% higher than current levels, then also it's at a book value of about one. PFC would be about 1.7 times FY25 book. So it's much higher than historical. But if I compare it to the broader power sector or even some banks, it's not very aggressive, I would say. So hence, given the strong thesis which I mentioned, we are still positive.
Right. Okay. Nikhil,
So it's
so
more a
good.
play to power sector,
Okay.
I would say. Yeah. Sorry.
Okay. So what to your mind, and again, these are cycles, financial cycles.
Okay.
So where are we in this cycle in terms of PFC, REC and the power sector? And where do you think the peak P multiples would be for PFC, REC?
So fair point. So if you look at the power cycle in India, and even if you plot, for example, the valuation of PFC, REC, along with a few power stocks and power prices, you will see a very good correlation. So for example, PFC, REC and NTPC move very much in sync with what power prices have moved over the last decade and a half in India. To your question, where are we in the cycle? See, the thing is, once power shortages start or a power demand supply situation start, it takes many years to resolve it. Because building a new thermal plant, for example, takes 4-5 years. So we think we are still in the early, or I would say the first quartile of the power cycle. The valuations obviously have re-rated much faster than that. So cycle, we are relatively still early, but the valuations for the broader sector are high. So one has to be selective.
Nikhil, so good to have you on the show. Thank you so much for speaking with us today.
Thank you.
If you like this video, then like, share and subscribe to ET Now.